Well, the Asian markets, they're mixed in morning trade. This after a turbulent session on the Wall Street last evening that saw the Dow Jones actually plunge more than 600 points at its lows and then recovered about 800 points from those lows as well. The Nikkei trading with about a 0.5% cut, some strength seen on the dollar yen, which has strengthened past the 111 handle. So that is further exacerbating the sort of pressure that we're seeing on the Nikkei. Remember, yesterday we saw a bit of a pullback come by out there, up around 3.5–4% for that index. The previous couple of trading sessions were slightly rough for the Nikkei, in line pretty much with how the Dow performed. But if you take a look at the Korean index, that one is outperforming. Yesterday was an underperformer. Today sitting with a gain of about 0.6%. There are a few trade troubles. The US President Donald Trump, I understand, is considering an executive order to ban American companies from using telecommunications equipment made by China's Huawei and ZTE, according to a report that came late last night. The Straits and the Taiwanese indices absolutely flat as we speak, but the SGX Nifty, that one should come for you. A big outperformance there if you take a look at it from from all the other Asian markets perspective, a start closer to the 10,900 mark than from where it shut yesterday. A 64 points uptick that indicates a good start to what is the January 2019 series.
Okay, so mixed cues coming from Asia, but it was a mixed and volatile session with the Dow swinging more than 800 points in trade yesterday on Wall Street, while stocks are raising heavy losses to end higher in a late session turnaround. The Dow ended the day up 260 points. The S&P 500 closed up by around 0.8% higher, while the Nasdaq Composite climbed around 0.5%. Now, in terms of the economic data, initial claims for state unemployment benefits dropped 1,000 to a seasonally adjusted 216,000 for the week ended December 22nd. Separately, the Consumer Confidence Index dropped to 128 this month, posting its sharpest decline in more than 3 years in December. CNBC's Josh Lipton gets us a wrap of all the action on Wall Street.
Dow ending up 260. It had been down more than 600 points at the lows, the S&P tacking on 21 and the Nasdaq adding 25. Americans' faith in the economy waning more than expected in December amid market volatility and concerns of a weakening economy. This month's decline marks the second straight monthly drop for the U.S. Consumer Confidence Index. Meanwhile, the number of Americans filing for unemployment falling slightly last week to a 49-year low, suggesting underlying strength in the U.S. jobs market. Meanwhile, oil prices falling 3% today after posting a gain of more than 8% in the previous session. The crude trade's been even more volatile than the broader market, down nearly 12% in the past month. And if you had some trouble navigating your Instagram feed this morning, you are not alone. The Facebook-owned photo-sharing app accidentally pushing out a software update to a large group of users, converting the vertical scrolling feature to horizontal scrolling. Instagram fixed that bug, but not before users took to Twitter to express outrage at the short-lived update. That's the action from the U.S. market. Now back to you in Mumbai.
Absolutely. Take your point on what took place on Instagram, and the accidental tweet that happened was, it was a tweak to perhaps stop people from mindlessly scrolling vertically on Instagram. Yes, we all suffered from that. But on that note, let's also hear out some opinion coming in from global experts on the road ahead for the U.S. markets as well as the Fed's rate trajectory.
This is a Fed that is data dependent, and it's not going to suddenly adjust. We can't expect them to suddenly back off rate hiking. It's, this setup for a pause is a process rather than an event. And we saw the first step in that event in December. We're going to see further steps, and we're starting to see the economy cool a little bit. I agree with David that we're not falling off a cliff, but that moderation in data will give the Fed room to become a little bit less hawkish, and I think that will ultimately support the market. And it's not just trade, it's about tech. We heard overnight that President Trump is considering executive orders on export controls to Huawei and the like. And even if we get a tariff deal, this concern about national security and regulatory issues in the tech sector, that's, I think, definitely a headwind and something that's weighing on multiple. So it's not all the Fed. We do have some genuine geopolitical concerns here that the market's grappling with.
Strong numbers actually might be more complicated for the market because it's going to throw a bit of questioning into everything. It's not going to be what you really want, particularly if those are on the inflation side. Now, I don't see that, and I think this year we've really seen an unbelievable turn in the inflation data since the summer. It has been extremely weak. The oil market's weak, but even the internals of the core PCE down significantly and decelerating. I think the Fed had every reason to put a hard pause into the marketplace. It was all set up for that. And I think politics got in the way and their ego got in the way a little bit, and that's what we're fighting right here.
There's really a big issue that's happening in the markets right now, which is that of liquidity. And the market is moving on this lack of liquidity. The market is moving on technicals and not so much on fundamentals. So we did always think that the magnitude of the run-up that we had was a little bit overdone. So I'm not surprised that we're giving some of this back. But I will say that watching the technical levels and watching the 2350 on the S&P 500 is really, really important. The reason why we rallied, I think, so much yesterday is because we managed to hold that very key 20% down level of the peak. So if we continue to hold that today, I think that should be a positive development for the market.
Okay, and with just 3 days away from the year end, the first month, January, could tell the tale whether US is entering the bear market territory. CNBC's Bob Bassani explains the same.
There's an old saying on Wall Street, as goes January, so goes the year. That's the January barometer, one of Wall Street's favorite seasonal gauges. According to the Stock Traders Almanac, it's registered only 9 major errors since 1950 and has been accurate roughly 75% of the time. But in a year when a lot of old saws are not working, this may or may not be the case in 2018. January saw a gain of almost 6%, but the S&P 500 is down in December so far. Regardless, interest for this coming January remains very high because every down January on the S&P since 1950, without an exception, has either preceded a new or extended bear market, or a flat market for the year, or at the very least a 10% correction. Now, the recent history of this January barometer has been a little bit mixed. 2008 was the worst January on record and preceded the worst bear market since the Great Depression. Very accurate. The S&P was down 38% that year. But down Januaries in 2009, 2010, and 2014 did not produce negative years, though they did foretell corrections. So that part was right. With a strong track record and so much market confusion around all these economic risks like China slowing and tariffs and the rate hike risk from the Federal Reserve and then the political risk in Washington, it's little wonder that traders are eager to get out of December and into January. But even if January proves to be a down month, there's always a bright side. According to the Stock Traders Almanac, down Januaries were followed by substantial declines averaging roughly 13%, providing excellent buying opportunities in later years. Well, that's a good way to look at it. I'm Bob Bassani, CNBC Business News, New York.
All right, so that's all that took place on Wall Street and all that is likely to take place in the American markets. But in Europe, the markets ended sharply lower following the global sell-off. Germany's DAX led the declines down nearly 2.5%. Along with that, we had the Italian FTSE MIB2 lower by about 1.8%. The DAX, with that decline, is now in bear market territory, which is about 22% of its most recent 52-week high. It's also on track for its worst month since January 2016 and worst year since 2008. Remember, the European markets opened with a fair shade of green, about 1%, 0.6% in the green, and have ended lower. And also, the European markets ended lower when the Dow was lower by about 450, 500 points. So we'll have to see what takes place in today's trading session, because the early rates that we're getting from European futures are in positive terrain. In the emerging market space, about 1/3% gain seen both on the Brazilian as well as the Russian indices. The Brazilian index, remember, has been a stark outperformer among all the world markets this year.
Okay, let's shift focus to the currency space now. The dollar index eases from previous session as risk appetite wanes and demand for safe haven rises, leading the Japanese yen to advance versus the greenback. The dollar index currently sitting at the 96.5 mark.
The world of commodities. Crude oil prices, they fall, retreating from a rally in the previous trading session as equities rebound. But concerns about slowing global economic growth continue to weigh, along with worries of an oversupply in the market.
Okay, time for a quick breather on the show. Up next, we'll get you all the cues and news you need to know for trade this Friday morning. Stay tuned for that.